Today we're going to be talking about 1031 exchanges. I'm sure most of you by now have heard about this, at least in passing. You understand that it's a tax deferment tool, most likely. But we're going to go into a lot of detail about what it is and how it can help you close a deal, which is what I know you guys are interested in. So what is a 1031 exchange? From a very broad point of view, you're basically trading the real property that you own now you're rolling over all of your gains, all of your investment into a separate investment property, a new investment property. Why is this advantageous? It's very simple. The IRS has Section 1031 of the code, which says that if you exchange like-kind property, and this is key, like-kind property. In our case, real property is always exchangeable for real property, so it's always like-kind. But it can also apply to personal property and other property used for business. You're basically allowed to defer any gains that you have in that sale until you sell the new asset. So, and this is the gist of the 1031 exchange. Let's say you have a property that costs you $200,000. Its market value is now $400,000. You would have a tax on that. You will have to pay tax on those $200,000 that you made on that property if you just sold it outright. But by getting into a 1031 exchange, you're allowing yourself time to pay that tax and to reinvest that money, that entire chunk of money, tax-free, into a new property. A more expensive property, a less expensive property. It varies. There's different rules for each type of deal, but we'll go over that.
But when you pay the taxes, then you have to pay the tax on the old property and the new property.
At the end.
Yeah, we'll go over all of this. Any questions? Well, it's going to be. You're going to understand everything, all of that, in a minute. So Section 1031, exchange of property held for productive use or investment. This is important. You cannot do this with your home, with the home that you live in. There are very strict regulations about this. And there are also very strict regulations for homes that are considered vacation homes. And we'll touch on this. But it only applies to property that you use, like an office building that your business is based at, or a piece of property that you're using for investment. It's an exception to, we talked about this, immediate recognition of capital gains, so it's an exception to this. Like-kind property, we talked about that. And okay, so what does real property mean? Because as you know, taxes are complicated and the IRS has definitions for everything down to the, so for our purposes, real property is any sort of building or real estate unit that has land attached to it.
Can it just be vacant land also?
You can exchange land for a building as well. As long as there's land involved, you can do it. I want you guys to understand what happens when you sell a property outright and don't use a 1031 exchange, just so that you can see the consequences of the regular tax consequences that happen when you sell a piece of property. Usually, you're going to take your selling price, you're going to add up any depreciation you took in prior years, which can be very significant if you held the property for a long time. I don't know if, depreciation is basically a recovery of the cost you initially paid for the property that you do over a period of usually 27 and a half years. Minus the original cost, minus the selling price, and this is going to be your gain on loss in the asset. You're selling a property for $100,000, it costs $50,000 to purchase. We've held it for a while, so we've taken depreciation of $10,000. And we paid commissions and selling expense of $5,000. We do our math. Our total gain is $55,000 on this property. So the point I'm trying to get at here is your gain is not. Especially for something you've held a long time, your gain can be extremely significant because of the depreciation recovery. What they call it the depreciation recovery tax. Immediately, as soon as you sell the property on that tax year, the $55,000 will become taxable. You'll have to pay tax either at a maximum rate of 20% if you held it for over a year, or 39.6% if you held it for less than a year. Let's say that you wanted to sell this property and use the proceeds to buy another property. You have a gain of $55,000, so at minimum, you will have to pay tax of $11,000. I'm sorry, of $5,500 if you're at the lowest bracket. Most likely, it's going to be more than that. So what happens? You're not going to be maximizing your future investment. If So this is when the 1031 exchange comes in. If you structure your deal through a 1031 exchange, especially if you're going to if you're going to mortgage your future property, you can get a lot more replacement property than you would otherwise, because the exchange is tax-free and you're getting more money in your pocket. You're getting more value in your pocket. So let's move on to the next slide.
Just one other quick question.
Yeah.
Is it investment property, not property you live in?
Yes. We'll go over vacation homes, which is the gray area, in a little bit.
I
Yeah.
want to clarify again, it's not a house that you live in.
Yeah.
Does it matter if it's commercial or residential? It doesn't matter.
It doesn't matter. It could be residential, commercial. It could be a strip. It can be vacant land. The only real restriction is that the land has to be involved. It cannot be just like an air conditioning unit for a building. Like, you can't do that. There has to be land involved. 1031 exchange comes in when your client's ultimate aim is to reinvest the funds from the sale into another property or another investment. You're essentially exchanging the current property for the new property, and you're deferring the gain tax, the tax on the gain. As we talked about, this is going to give you more money to invest in the replacement property. And especially, and this is key for you guys, especially for a client that's on the fence. Like I have a client who has a condo that he bought for, I think it was $4 million. It's worth $8 million now. So when you add depreciation, his tax is huge. I mean, and he's a corporation, so he pays even higher tax. So his tax is about $1 million to $1.2 million. So imagine how much of a difference that will make if he were to reinvest this money, especially if he's getting a loan for the new property. I mean, it could mean the difference between a great deal and a mediocre deal, really. And for you, it could work as a real powerful selling tool, real powerful. Okay, so another important point, the deferral of gain recognition is not time-bound. Any gain on the property, you're not going to pay immediately. You're going to pay when you sell the replacement property. So you can hold the replacement property for 30 years, and you will not be paying tax on that money. You just won't until you actually sell that replacement property. Or you can just keep rolling it over on 1031 exchanges forever and just keep growing your net worth. Now we're going to get into the nitty-gritty of what an exchange is and how it should be structured. Simultaneous swap. This is how the actual 1031 provision originated. It was mostly for farmers when they were exchanging livestock. In 1979, there was a big court case where it was not property for property. There was a time lapse in between. The plaintiff won, the IRS lost. So now we have deferred exchanges and reverse exchanges. Deferred exchange is the most common. You're going to sell your property through an intermediary. The intermediary will hold the funds. You'll have to comply with certain time limits, but then you'll buy the property through the intermediary. The intermediary will exchange all the money, and then title will be transferred to you. And this doesn't have to be simultaneous. It can take up to 180 days for you to do this. Reverse exchange is the reverse of that. You buy the property first, you park title with the qualified intermediary, and then you sell your property. So let's go to the next one.
Quick question on that. Is
Yeah.
the same time frames?
It's 180 days. I mean, for the deferred exchange, there's 2 time limits that we're going to go over. For the reverse exchange, there's only 1 time limit, which is 180 days.
Okay.
Yeah. Qualified intermediary. This is the key point, guys. The client cannot ever touch any money that comes from the sale of that property. If the client touches a cent, it's done. You have to use a qualified intermediary to handle the transaction. And it cannot be me, it cannot be his attorney, it cannot be anybody that the client can trust with his money. It's a very stupid rule, but this is the way it is.
What do they charge for the service?
Usually, the people that I work with, between $1,000 to $1,500 to structure the deal, which is not bad at all, really. I mean,
Can I ask you a question on this?
Yeah, of course.
Because I'm always confused by this. Is it the gain that has to be reinvested, or the entire amount of the sale?
so we'll go over that in a minute.
Okay.
Yeah, that's where it gets tricky, but we'll go over that in a second. Okay. Always, I mean, and I've heard horror stories about this. People that tell you, oh, I'll hold your money and buy the property, and then they just file bankruptcy. Always make sure that they're insured and bonded. This is pretty common sense. Actually, I think Wells Fargo works as a qualified intermediary. So if you don't know anybody that's trustworthy, just go to a big financial institution. They'll take care of you, as long as they don't have any money in that bank. Okay, so like we were saying about time limits. Deferred exchange, the most common exchange, which is where your client will sell his property, then identify a new property to replace it with, and then buy that new property. The process is like this. You retain your qualified intermediary. That's step number one, always. You sign all your documents. You prepare any contract for sale, you prepare it under their guidelines. And then you sell. So what happens when you sell? You have 45 days to identify replacement property. So within these 45 days, your client has to identify up to 3 properties to replace the property that he just relinquished. Relinquish is the fancy tax term for sale. Usually you have to do this in writing. You have to submit it to your qualified intermediary and anybody that was involved in the sale of the property, real estate agents, etc. Once you identify these 3 properties, you then have 180 days from the date of sale, not from the date of identification, to close the deal. Close on any of those 3 properties that you identified, or all 3 if you're exchanging for more than 1 property. Is there leeway in any of this? Absolutely not. 45 days, the only way that the IRS will even consider an extension in this time limit if the president declares a disaster area. It doesn't matter if the property was caught fire and it was destroyed. You will just have to live with it and pay the tax on your sale. So it's extremely important for you to identify more than 1 replacement property, always. And you have and the IRS allows it. So if you're involved in one of these, just always advise the client to do that. Reverse exchange, as we talked about, it's only the one-time limit, 180 days from the day you buy the new property until you're actually going to sell yours. And again, you're always going to do it through the qualified intermediary. You're not going to hold title to the new property until you actually sell yours. The qualified intermediary is going to hold title throughout that time period. Park title, that's kind of how we call it. And then once you actually buy the new property, once you actually sell your property, then you can the intermediary will give you title to that, to the replacement property. Boot and basis. So boot is a fancy tax term for cash. And basis is a fancy tax term for your original purchase cost on the property. Your basis is not just the cost. Your basis also includes any depreciation you've taken in the prior years, any capitalized expenses any selling expenses that have added to that basis. Whoever filed your taxes will know what that is. And you can find out by looking at your tax return and seeing what your tax basis is on the asset. Now, what happens to boot and basis when you go through a 1031 exchange? Basically, boot, any cash, becomes, so let's say and this is why we always recommend exchanges to be for something across or higher. We never below the value of what you're trading. If you get cash out from that sale, you'll have to pay tax on the prorated amount of gain for that cash you took out. So, for example, let's say your property costs $100,000. On top of that, you have a $100,000 gain. The total market value of the property you're exchanging is $200,000. You exchange for a property that's worth $150,000 plus $50,000 in cash. So your prorated amount of gain is a quarter, because you're getting a quarter of the market value back to you in cash. So you're going to have to pay a quarter of the gain of the tax on a quarter of the gain. So $25,000 will become taxable of those $50,000 you're getting back. A very important point on boot is normally in a 1031 exchange, any closing costs like commissions or any retainer fees for your qualified intermediary, etc., do not trigger this boot rule. If some of the proceeds from the sale are used for that, you will not be liable for taxes on that money. But any prorated rents, escrow taxes, escrow insurance, all of that is considered boot. So what we recommend clients do is that they bring cash to the closing table to take care of those extra little things that are not covered in the regulation. And that's important, because if you just trigger a gain on $5,000 of prorated rent, then you have to file a ton of forms, and it just becomes way more complicated than it needs to be. It's much simpler to just bring in some cash to closing and take care of it, move on. What happens to basis when we do a 1031 exchange? As we talked about, basis it's the basis, that's why it's called basis, of calculating any gains that you have on the property once you sell it. Obviously, you're going to have to pay tax on this money at some point, okay? It's not a tax-free deal. The IRS always gets its cut. So What's going to happen is that, let's say you're trading a $100,000 property for a $200,000 property. Normally, if you just sell your $100,000 property and then buy that $200,000 replacement unit, your tax basis for the replacement unit is $200,000. So you would only pay tax on any gains on top of that $200,000. In a 1031 exchange, that's no longer the case. So the basis of the old asset is going to transfer to the new asset. So the new asset, instead of it having a basis of $200,000, it's going to have a basis of $100,000. So what will happen? You will pay tax once you sell that new replacement unit for whatever, whatever appreciation you had, 230, 240. You will not just pay tax on the $40,000 gain, suppose. You'll pay tax on the whole $140,000 that you have built into that property. Okay? That's very important for you to know. I mean, it's just a method of deferring the gain. I mean, of moving it to a future period. It's not a tax-free deal at all. It's not. So now let's open the floor for questions. Anything you have? Anything that wasn't clear?
How does this apply? I mean, can it be applied to an international swap?
So if the owner or buyer are foreigners, that's fine. If the property is located outside the United States, no. It can only be for property in the United States. Yeah. Or I mean, or the United States Virgin Islands. Within the United States territories.
Right.
Yeah.
Okay.
Do you have any way of avoiding paying taxes altogether?
Cheating.
Shows.
Yeah. Unfortunately not. Anything else, guys?
The property being identified within the first 45 days,
Yeah.
what is the time frame of the closing of the next property after it's identified? Can it be like 120 days later? As long as it's identified prior to, and that money's gone to that intermediary?
Like if you already have a pretty good idea of what you're doing, you can do it all as fast as you want. Really. I mean,
No, I'm talking about slow.
huh?
I'm talking about slow.
So
Fast,
slow-
I understand.
Right. Fast is
Slow
fine.
part.
Slow, you have 45 days to identify, 180 days to close. Both
The money's in the intermediary.
Yeah.
If the money does not go to an intermediary,
You're done.
You can't do it.
It's done. There's nothing you can do about that. This is not something like taxes that you can go back and
You can't
fix.
play.
You know, it's
you can't touch the money. If you
No.
touch the money, there's nothing to talk about. Game over.
game over. And if they ever question it, forget it. You're gonna get destroyed. So, really, the really key point here is just to contact that qualified intermediary from day one. As soon as you have a client that's interested in doing one of these things, contact the intermediary and have them guide you through the process, set up the paperwork, and handle the.
Do you have? I guess my I don't know if it's my last question, but can you do a partial pull out of that money? Like for example, if it's $1 and they want to take 30 cents and reinvest the other for the 1031, can they pay taxes on the 30 cents?
Yeah, of course.
And do the
That's
rest
what we're talking about the
pool.
pool. Yeah.
Separate it, you can do that.
Yeah. You could. Yeah.
So if
The-
it's a bigger, like it's a, whatever it is, doesn't matter what the sale is, if it's $1 million, $10 million, or 100,000, if they want to take some of the profit out today, they can.
They can. You'll have to pay tax on that 30%. Yeah. But
So that,
of course.
that goes back to my question. So in your example, you had a $100,000 investment, and in your math, it came to be a $55,000 gain. So the 45 was still left as the original investment, which is not taxable.
Exactly.
You're not able to pull that out and only reinvest the 50.
No. You'll have to pay. I mean, so let's say that same case. You have the 50. You pull $20,000 out of that gain.
They consider they take out the gain first before the principal.
But so it's not like they're gonna take all the $20,000 and I mean, so and this is where we come in because we calculate this stuff all the time. You're basically prorating. So let's say you're gaining $55,000 and you're taking
55% off.
exactly, and you're taking out 10% of the total cash from the deal. You'll pay 10% of that gain, not $10,000 completely. So 10%. So you're taking 10% out of the cash. You're paying 10% of the gain, which is $5,000, not $10,000. You follow me?
Okay, so you'll only, if the percentage was 55%, in your example,
Yeah.
and I pulled out a third of the money,
Uh-huh.
I'd only pay, on that third, I'd only pay 55%, I'd only pay tax on it. The rest of it is tax-free, 45% is still tax-free.
Correct. You'll pay 55% of the 30,000. Yeah. Of the 30%. Exactly. And that's kind of how it goes. And boot can be really cash. It can be cash. It can be property that's not like kind, but those are very rare. I mean, and that's what's going to happen. You're just going to have a small portion of the deal become taxable. That's it. Any other questions, guys?
Oh, awesome. It's really informative because this is a great tool for everybody to use, especially with your investors. Obviously, it's for your investors, not the homes, but it's a way to not only help them avoid taxes, but you guys get another commission because you actually do another sale.
Yeah.
So it's a great tool, and I suggest before you get involved, you call these guys and get organized. So let them get on the phone. I'm sure they'll be able to explain the process because not every accountant is sophisticated in this.
Yeah.
They'll help you get through the process.
Who
Make you look like a
coordinates all of
Makes
this?
it a quick sale.
I'm sorry?
Who coordinates all of this with the paperwork and the
So
utilities
we'll
and the QI and you guys and you
so
know?
we'll work as your point of contact. We work with a QI very, very closely. And we know their process.
Streamline everything.
Yeah, and you know, if the client has an attorney that they work with, okay, we'll work with them too. But you know, we usually, when all of our clients, we just work as the point of contact.
Okay.
And we work with Title and Title very closely too, so it just becomes a very organized unit. And the client only really needs to see us. They don't really need to.
Oh, that's good because life is difficult enough.
Yeah. Uh-huh.
If we could revisit the vacation home, because I know.
Oh my God! Yeah, I'm sorry. I completely forgot about that.
So. 'cause
Completely forgot about that.
Is it correct that if you at least rent it X amount of time?
Yes,
I think it's like
so-
25%?
Not even. It's very simple. If you rent it for at least 2 weeks out of the last 2 years to someone who's not a family member, you're good. And you didn't
Oh, 2 weeks out of a year?
out of 2 years.
Okay.
But here's the kicker: you cannot live in it for more than 10% of the time.
Okay.
Yeah. So there's those two rules. You can rent it out for, and
Basically, five weeks of personal use max a year.
yeah. And here's the big thing: you have to declare that income, okay? So because if that property didn't show up on your Schedule E from either the last year or the year before, you're gonna have a real hard time telling to the IRS, oh no, yeah, this is an investment property; it's not a vacation home. So that's because remember, there's a difference between reality and what you can prove. So if you don't have that, you really cannot prove what happened. I mean, you're evading taxes. You're not paying taxes on whatever money you got in from a property. So that's kind of how that plays out. But it's very doable. It's very doable. Up until 2008, there wasn't really any guideline up to this, but you know they issued pretty good stuff for us to work with. So just remember those two. Cannot live in it for more than 10% of the time. 2 weeks rented out of the last 2 years. That's it.
Do any of the rules change if the owner is a single person, married couple, or LLC corporation?
No.
Or they applies?
Applies to every taxpayer. Yeah.
Okay.
To every taxpayer.
Should it be like 100% of, if you have it like a corporate name, should it be 100% owner of the corporation, and the corporation owns the property to do this, or is there any percentages? Can they be 25% owner, or does it matter?
Okay, so if you have a situation like that, then let's talk because that gets way more complicated. Yeah.
Awesome, well, thank you. Again,
Of course.
very informative. We enjoyed.
Of course.
Terrific, important information.
Yep.
to utilize.
Yeah, we'll stick around for a couple minutes. If you guys have any more questions, please let us know. Mhm.